Hey everybody, so in the first episode of our learning series, we're going to talk about the 4 pillars of real estate, that being cash flow, appreciation, leverage, and taxes. With cash flow, that's a primary reason a lot of people want to get into real estate investing. And you may need extra cash for a number of reasons. Maybe you want to replace the income from your W-2 job. If you like your W-2, maybe you just want some security. So if something happens and you lose your job, you have money coming in to be able to pay your bills and expenses. Maybe you're saving for your kids' college, or whatever the reason could be that you need cash flow. Cash is king, right? Who doesn't want that? Now, appreciation is different in the single-family market and the multifamily apartment market. In single-family, your house is valued for what the property next door sold for. So if you're in a hot market and prices are increasing, that's why your property is going to end up being worth more, because all the surrounding comparable properties are selling for higher. With multifamily, it doesn't really matter what the apartment building next door or down the street sold for, even though you do want to look at what they're trading for, but at the same time you force the value based on the cash flow of the building. So that's net operating income, basically income minus expenses, and that's how your building is valued. So you can actually force that value. If you increase the expense or increase the income and decrease the expenses, then you can increase the value of your building, and that's super powerful. The next one is leverage. Now, what other asset class can you actually borrow somebody else's money, like a bank or lender, and buy a property for quadruple the value of the amount of capital you're actually putting into it? For example, if you were able to save up $100,000, let's just use that for ease of calculation, you can get a loan from the bank and borrow up to $400,000 worth of a building. So that is the crazy part about real estate and multifamily. But in any case, leverage is super powerful in being able to let you control more building than you actually have purchasing power for in cash. Now, let's say you employed one of the strategies of increasing the value that we just talked about by raising the rents, decreasing the expenses, and making your NOI stronger. Now you've increased the value of the building. So even though you came in for for a $400,000 building, let's say now you increase the value for even more, you're able to refinance, which is a strategy a lot of people use, a lot of real estate investors use. You refinance the building, you pull back out that $100,000 that you put in, and then guess what? Now you can use it. You still own the building, you still get the cash flow, but now you have your $100,000 back, and you can use that to buy another building. So with the tax benefits, now you can claim depreciation against the rental income that you're getting from the building. So let's say you get however much cash flow you got from the building over time, now you can actually write that off as if you didn't get that money in your pocket. And a lot of times there's different strategies to increase how much you can depreciate. There's a standard amount of years that you can take off for the value of the building. Then they'll divide that by a percentage, and that's how much you can take per year. If you employ an even more detailed strategy called cost segregation, you can accelerate that and basically write off more per year than you would be able to do with a standard deduction. I think people don't really understand. It sounds complicated, and they don't understand how powerful that is. So I could get $10,000 or $20,000 worth of income in cash flow from my building, but at the same time, then you can write off almost $20,000 or $25,000, just depending on the strategy. Or let's say you get $20,000 and you get to write off or depreciate 10. So it means in the IRS's eyes, you only made $10,000. That's $10,000 less you're getting taxed on. Another tax strategy is the 1031 exchange. So let's say you, instead of refiing, I gave that example, you refi, get your $100,000 back. But let's say you sold the building and it appreciated a lot more. And so instead of getting $100,000 from a refi, you sold and you got actually $200,000 in profit from the sale. But now what happens? Now you get taxed crazy for that, unless you want to use a 1031 exchange, which means you're basically exchanging that capital, that $200,000 that you got, and $100,000 of that is profit, and you're exchanging that from the one building to a new building. So instead of being able to just take your your $100,000 and buy a building with similar size, similar value, now you can double that. So now if you have $200,000 because you sold it, now you can put that into a building worth almost $800,000, and you don't have to pay any taxes on it. If you had paid taxes, let's say you only get to keep $150. I'm making these numbers up, but it's just for an example. But if you keep $150, now that's lowering the amount or value of a building, a new building that you can purchase. So if you're layering all these different strategies and techniques and kind of do the education to know what you're doing, or invest with somebody who knows what they're doing, then you're able to take advantage of all these different strategies and make sure that you can optimize over time your initial capital investment. And that's why we really like multifamily real estate.